So welcome back to the show. Obviously, we don't want to totally monopolize the show with conversation about our big announcement, our new book, Next Gen Dollars and Cents. We want to help make some sense out of some dollar decisions that you may very well be facing right now. Chief among them is some of the things that happen in the Secure Act that ultimately impact your retirement. 90 different changes in that one piece of legislation. Christina, you've spent some time kind of going through the details, and you've got some things that are important for this year to focus on in terms of those changes.
Yeah, absolutely. So as Joel said, there were 90 different changes implemented. However, we're going to focus on the four most important for this year. So that is the startup tax credit for retirement plans for employers. So this would allow if an employer starts a new retirement plan to receive some tax credits, and that's for small businesses. The next is relaxed required minimum distribution rules, or as we refer to it, your RMD. The third is the Roth option available for employer contributions. So the Roth option is an after-tax option, which gives you a little bit of flexibility once you retire. We'll get into that a little deeper in a minute. And the fourth is also a Roth option on simple and SEP IRAs, which are generally for small businesses, I guess you could say, with not so many employees.
So a lot to go through there. Let's start with kind of some of the some of the tax credits. I guess the notion behind that is to encourage employers, I guess smaller employers, to establish these types of 401k or other types of plans for their employees to be able to participate.
Yeah, absolutely. So the startup credit basically has two parts, and that's helping these smaller firms, encourage them, I guess you could say, to have a retirement plan. So the first part allows a credit for the startup costs. So that would include things like a TPA, which is a third-party administrator. There's also record keeper costs, which keep track of all the contributions and tax forms and things like that. And then also they can get reimbursed for financial professionals.
Wow. Okay.
Expenses.
So even like the cost, if there's a financial professional cost, then they can even reimburse for that. Wow.
Exactly.
That's great. Yeah, and that obviously would help to offset the cost of implementing the plan, because particularly for a small employer, those costs can be kind of significant.
Yeah, definitely. Especially that first year, getting everything together and coming up with a game plan. So the second part of it, which probably ultimately is a bigger piece, but up to 100% of employer contributions for the first $1,000 per employee who make less than $100,000, they will receive a credit for. So that's each an individual employee that participates.
So that really is not just so there's two parts of this, and that second part, I guess, is the newer part, right? Mm-hmm. So the first part, okay, yeah, we're going to give you a tax credit to offset the cost of setting up a new plan.
Right.
The other part of the tax credit, though, is now we're giving you a tax credit for you, the employer, to actually make that employer contribution on behalf of your employees.
Exactly. They're enticing them to make that match. I think in COVID era, if you would, we sort of saw that back off for a lot of companies as just a way to save some money and get by, which is understandable. Didn't always come back for everyone. Right. So I think they're really pushing for that.
Wow. No, that's pretty powerful. So so that's kind of the big first one out of the box. What then the next one I think you mentioned was about the RMD rules, and maybe those have kind of shifted a little bit as well.
Exactly. So the RMD is your required minimum distribution. So once you reach a certain age and you have a retirement account, you have to take this distribution. Now, previously, it was 70.5 a few years ago. It's been gradually increasing. We're currently at 73 is the age where you have to start taking your RMD. And that is also going to bump up in the next 10 years to 75 way out in 2033.
So you've got some flexibility on the required minimum distribution and kind of the time within which you'd have to start to take that.
Yeah, and now the other thing they adjusted with that, which I've always thought was just a little ridiculous, was the penalty if you didn't take your RMD and you were supposed to. It was previously at 50% of the required minimum distribution amount, which is really excessive.
One of the highest penalties in the tax code.
Yeah, it was just sort of absurd. Anyways.
Because you'd also then have to pay the taxes.
Right.
So like...
Pay the taxes on the money, but then also pay the penalty
right, so
that you didn't get.
So it could easily add up to be 70-80% of the amount that you would have taken. I mean, that's how draconian that penalty is. So the Secure Act 2.0 finally got around to sort of addressing, or at least try to adjust that. Right. So how did it do that?
And they dropped it down to 25%.
Okay, so a little bit more reasonable.
A little bit more than half. And there is a little clause in there as well. If you didn't take it and you realize it within a timely manner, whatever that exactly means, they're going to drop that penalty down to 10%. So let's say you make up and you take it the next year, instead of getting the 25% penalty, it's only the 10% penalty.
Okay, so good. So at least the ability to correct after the fact, where before you never really had that had that option.
Exactly.
Yeah. Right. Interesting. So then, I guess the other big change from the Secure Act had to deal with sort of expanding the Roth option, right? And so just to recap the difference, so you got the traditional, which is if you put money in, you save on your taxes now, but when you take it out, you got to pay taxes. The Roth, you don't save on your taxes now, but when you take it out, it becomes tax-free in retirement. So the Secure Act, I guess, expanded the Roth.
Exactly. So previously, only the pre-tax option was available. Now, employer contributions can go towards the Roth side as well. Now, it is up to the employee how they want that to happen, but it gives them a little bit more flexibility if for whatever reason they don't want to take the deduction now, I guess you can say, especially for our young folks out there, that it might be a better option for them when they're making less earlier on in life.
Yeah. Well, and now the Roth sleeve for the employees is relatively new as well, but that's been around for a few years.
Correct.
This change has to relate to how you direct the employer piece.
Portion, yes. And the good thing for the employer is it's still a deduction for them.
Regardless of which the employee chooses.
Correct. Whether they go on the Roth side or the traditional side, the employer still gets that deduction.
That's really interesting. Yeah. So I mean, if it doesn't make a difference, then I would imagine more often than not, and we really haven't kind of fully analyzed this, but my gut would say that if your employer's making the contribution, you might as well just have them do it on the Roth basis.
Right, because that's not part of your income anyways.
Right.
So you can have a little bit of both worlds. It doesn't have to be all Roth or all traditional. You could do a little bit of both.
Interesting. And that's for this year. So folks need to be aware of this now and be adjusting how those contributions are getting made into which sleeve of their accounts they really should be putting that money. Yeah.
Absolutely. Yeah. Absolutely. Those changes can be implemented now. So the fourth is Roth Simple and SEP IRAs. So Simple and SEP plans generally were only available traditionally, like a traditional IRA, if you would, prior to this. This now gives that flexibility to what I would call our smaller businesses who generally don't have that many employees. These plans are a little cheaper to run, which appeals to the smaller businesses, but they now, too, can have the Roth option.
So that's really kind of interesting as well. We're now... in the 401ks, 403bs, a few years ago, they added in the Roth option. Now, pretty much now I guess every type of employer plan out there is now has the Roth sleeve.
Yeah, I think the real goal, they were trying to make some changes for retirement plans based on the fact, like you previously brought up, that we no longer have pensions for the most part. So this is giving, employees a little bit more flexibility As with anything, make sure you do your homework to understand how each of those options are going to affect you. It may work for you if you're a younger person to do the Roth side. You may need that tax savings, though, if you're kind of in the height of your career and making the most of your income, to keep with the traditional side where you get the tax savings now.
Yeah, certainly. But on the employer contribution side, then you can say, hey, I'm going to do that on the Roth side.
I think that pretty much stands for anyone.
Yeah. I would. I don't
almost
know
should
that
be a default.
That's what I'm thinking. I mean, we haven't kind of really fully, because this is all brand new stuff. But yeah, that I think is kind of where I would fall on the decision. So, but anyway, hey, that's why we do the show each and every week, to keep you abreast of the latest and greatest. I'm sure we'll be talking more about these changes, and then there's obviously in the years ahead a lot of changes as well. So we're going to continue the conversation here on Dollars and Cents when we return after these messages. This is Joel Garris. Joining me is Christina Lamb here on Dollars and Cents.